Hello traders, the title of the video is how to use Elliott wave principle to improve initial public offering, investing or trading. Alright, so when we are talking about initial public offering, we are talking about IPO. Alright, IPO it stands for initial public offering. When a private company is coming to the public market for the first time, is being listed for the first time, that's what we call the initial public offering. So company X come to the market at the price of $30, all right, or at the price of yes, at the price of $30 in the market. That's the initial public offering. That company was private before, it belonged to a few individual people, but those people decided to list that company on the financial market, and they have to go through what we call the initial public offering. Now, the question that we want to answer today, the question that we do care about at the 24 Elliott Wave YouTube channel, how to use the Elliott Wave principle to improve the initial public offering, investing or trading. So they come to the market for the first time, you want to use the Elliott wave to know at which price you should buy and hold that stock for many years as an investor or as a trader. That's what we are about to talk about today. So in fact, alright, if you were not my friend, I should be charging you how much? Let me know in the comment section how much I should be charging you normally if you were not my friend for sharing this information with you. Alright, this to make you laugh a bit. Alright, so I have started a series of video that I consider very important series of video at 24 Stock Trader YouTube channel, digit 2 digit 4 Stock Trader YouTube channel. That series of video I post it on the playlist that we call Mastering Common price structures in the financial market. Now, if you want to remain my friend, alright, make sure you watch those videos. I've posted so far 3 videos in that playlist, and I'll be adding 2 more videos. So if you want to stay my friend, to remain my friend, you need to watch that playlist at 24 Stock Trader YouTube channel. Alright, if you haven't watched them all, let me know so we all separate together and we don't talk anymore. Alright. So, what are we talking about here? A stock coming to the market, this stock coming to the market is listed at $30. So you are itching and say, ooh, probably this stock is going to make more money. Alright. And how do you know whether they're going to make money or not? So one thing that you can do, alright, if you are not very sure, you want to have a bit of idea how real-time investor make decision, watch a Shark Tank video, shark as a shark in the sea and tank as a T-A-N-K, Shark Tank videos on YouTube. Watch also Dragon Den videos. That will help you to have a bit of idea what investors, how the investor analyze a company before they buy it. But in this tutorial, we want to talk about how we can use the Elliott wave principle to identify companies that we can buy and hold. Alright? So they come into the market at $30. And as an Elliott wave trader, we know that the minimum price move is free. So the time frame that I want to use for this exercise is the monthly chart. Some stock, as you can see here, this stock did something very interesting. It just went down 1, 2, 3. Can you believe it? It did that. Sometimes it may not do that. Some stock will do that after the initial public offering. So my recommendation to this stock listed on the whatever, they begin their initial public offering. You may put that stock on your bullish watch list or bearish watch list, and within 1 year you are monitoring the price structure of that stock. Will that be helpful? I think that will be helpful. So let's talk this stock here. Suppose it opened at $30, all right, at that point in time, if I'm not missing any data here, all right, 2014, that's November, all right, came into the market, it's at $30. Okay, here we are. Which month is this? 2015. Now we're in September, almost a year now. So after 1 year, look what it did. It printed 1, 2, 3. So for us and any other traders, we know the language of the price, we understand the language of the price. We say minimum price move is free. So you say, wow, this stock was listed in November 2014. Now in September 2015, we have minimum price move free. We need to keep our eyes on this stock. Do me a favor, alright? Don't be the purest area wave trader. You need to go to Google Finance, perform Google Assist test, check the product of this company, alright? What kind of business they are doing. This is about the Shark Tank and Dragon Den. This company belongs to the oil and gas, sector, energy sector. What's happening there? What is the future, and so on and so on. And then you apply your area wave principle. Minimum price move is free. So here we are. We see here 1, 2, 3, and this one come out this month. You see here. See, wow, this is a bullish engulfment after minimum price move is free. So we will draw a line here. You see, normally we should hide the high, the low, and the median line of the engulfing candlestick by this one. Alright, so after the initial public offering, 1, 2, 3, do not just buy because of the area wave and the price structure. Do your due diligence, very, very important. If you want to buy a hold, check the management, check the product, watch few of video of Shark Tank and Dragon Den. That will give you a bit of idea how to be a fundamental trader for the first time in your life as a die-hard technical area wave trader. And perform at least Google Assist test, check the balance sheet. Alright, if you fail the Google Assist test, check the management, see what's happening for them. Alright, so after that, go back to your area wave. Minimum price move is free, is here. Good. You see bullish engulfment, another authentication. You remember multiple authentication. Minimum price move is free. Now we see bullish engulfment. Good. Now know how to trade the bullish engulfment. What you need to do at this junction, you will also combine the area wave principle with Fibonacci. What we have noticed, a price like this, so what the price has done, it done something very strange. So they came here, the first reaction people saw it, which means probably people think that the stock came into the market at the wrong price. So they say $30, that's too expensive. The smart money know that. They say, oh, no. That's more than 22 times your net profit in the last 5 years. So we can't buy that. They say, alright, the correct price is $17. Smart money say, bring the price to $17. I'm not saying that this is the case here, but just think of it that people having a discussion behind the scene, looking at the intrinsic value or the fair value of that company. Alright? So they will say, alright, I don't want to buy it at $30. I would prefer to buy $17. That will be a more reasonable price. Okay? Watch Dragon Den, watch Shark Tank, and you know what's going on. Alright? So now you as an area wave trader, you see minimum price move is free. You see here it's good. You will combine it with your Fibonacci trading. So what we have said to trader, talking about that series of video I was talking about before, the 2-4 stock trader playlist, mastering a common price structure in the financial market. If you want to be an investor, sometimes what we usually see, the stock normally will come like this and will go up, so become overbought, and then we apply Fibonacci extension reverse to this session. Trader that are following us, a 2-4 Elliott, 2-4 stock trader, understand what I'm talking about here. And we apply Fibonacci extension reverse to this session. You will be below the opening price somewhere here. If the financial instrument came down to reach that reverse Fibonacci extension or this move up somewhere here, that's a good place to buy and hold, provided the market environment is viable and they have a brighter future. That company has a brighter future. But what has happened here is a little bit different because the price did something else. Straight away it went down. So we will be thinking that it's going to go down more. So you see here it's going down. It reaches this low here. Yes or no? And then it bounced up. Why is it bouncing up? Because there are buyers there. People think that, oh, all right, this stock, are you getting the message? So some market participant looking at this stock say, it came into the market at $30. Look what's happening here, my friend. It's now at $23. You should be stupid not to buy it. So people buy it here. Then it bounced up. So remember what I said to you. They bounce up. So normally when it comes to the market, it should do something up first before coming back below the low. This is about our price structure. But what it did, it went down first before going up. Nothing has changed. Suppose you were here, all you need to do is to apply Fibonacci extension to this move down, or you apply Fibonacci extension to this move up, reverse. So if you apply Fibonacci extension to this one, normal Fibonacci extension, your 138.2% will be here. That's the key Fibonacci level where you will be interested to buy. You can see that this candlestick bar, after this one close here, the following one stop at 138.2% level right there. Again, this candlestick bar here, there were buyers here. You see, that's why we got a tail here. This one pushed through it and went a little bit below. Why? This one went too far. So, but as an investor buying and hold, you don't care. You have a portfolio. It's not about technical trading. They're not going to take you out in one day. You buy and hold a real share and hold in a real portfolio. You are just holding on to it, and then you hold it for a few years. So you bought in 2015. Now we are in 2017. Here we are somewhere at $33. So if you bought it at this level, $20, now $33, that's not good, bad, isn't it? So will you say that you can use Elliott wave with the initial public offering to make SM decisions? So you may say, Joe, why did it go there? And I will tell you why. Okay, stay with me. This has something to do with the Elliott wave traders. And if you are using Elliott wave, Fibonacci, this has something to do with Fibonacci traders. Alright, correction. Something to do with Fibonacci traders. If you are using Fibonacci retracement, Fibonacci extension, and you are doing your own thing, that's not good. Always take into consideration other traders. So those who draw their Fibonacci extension like this had their 138.2% level here. Other traders who draw their Fibonacci extension like this had their 138.2% here. And that's where they see the 138.2% on my left hand side. That's where they push it down. So not all traders are drawing their Fibonacci extension the same way. The one group is putting it there and the closing from the closing price to the closing price. Another one is putting it from the high to the low. And those who put it from the high to the low had their 138.2% level. That's why the price came down here and we had that gigantic bullish engulfment followed by a higher low. So a bullish engulfment followed by a higher low is what? It's a high probability trading setup. It's like a double bottom followed by a higher low. It's a high probability trading setup, or a double top followed by a lower high. That lower high is a high probability trading setup. So a bullish engulfment followed by a higher low is a high probability trading setup. This is about the language of the price, or the price action, or the price structure itself. Am I making sense? So now you, as an Elliott wave trader, there was an initial public offering, IPO, at $30. Price reacted like this. If you didn't see it quickly, you may say, okay, minimum price move is free. After 1 year, you put it on your bullish watch list. Here it is. You draw the Fibonacci extension, go into the mind of both Fibonacci traders. You draw this level, and you draw this level. Say, I'll be willing to buy at $20, and also I'll be willing to buy at in the zone of $17. I want to buy and hold because I like the story of this company. They have a brighter future, and the market is looking good. Give it a chance. It comes here, you buy. You know what you are doing. Now you printed 1, 2, 3. Minimum price move is free. All right. What do we say to trader? Which first wave is starting here? Price goes below this low. This is what we call the irregular first wave. So you start counting your wave. George, this bullish engulfment on a monthly chart looks to me like a first wave on a monthly chart, and this is the second wave. Feel free to disagree, George, as you always say yourself. And I say we are now in the third wave, referring to the video that we have posted recently, that George Trio has posted recently, talking about area wave analysis tips. Alright, how to surmount. You remember that video? Area wave analysis, technical challenges are 2 for area wave YouTube channel. So, one more time, the title of that video was area wave analysis tips, how to surmount area wave analysis, technical challenges. And you say, George, in that video, you say that in one way to surmount the area wave technical analysis is to use the stochastic 833. When a stochastic will stay overbought for a long time, that can help us to identify the third wave. So you may say that's why, George, this is the first wave, first irregular first wave, second irregular first wave on a monthly chart, and this is the third area wave on this monthly chart. High probability that we may see another move up unless we're going to have an area wave failure. Alright. How to use area wave principle to improve initial public offering, investing, or trading. This is a practical things, practical area wave application as an investor or trader. One wants to buy and hold a stock, but one wants to use the area wave theory, the area wave principle, and the initial public offering. A stock is listed for the first time in the financial market, in a public market. A private company becomes a public company and listed at $30. A phenomenon has occurred, talking about mastering the common price structure that we are discussing at 24 Stock Trader YouTube channel, that playlist, mastering common price structure in the financial market. Here it is, the stock went down. Why the stock is going down? The first day is listed, or the few months is listed, is because the highly sophisticated market participants think that the stock came into the market at a high price. Don't think that those who are listing the company are stupid. They know that people will sell, or they may not accept the price. So they put it at a high price, they overvalue it purposely. If people buy, that's good for them. They know for sure the fair value. Probably they knew that the fair value is in the zone of $17, but they say no, let's put it on the market for $30. So if they sell it, it doesn't go too far below the $17. So all kind of things go into the mind of people that are listing that company. Alright? So now the highly sophisticated market participants analyze their profit, the net profit over the last 5 years. They notice that, alright, these people, the price they are quoting on the market is almost 22 times or more than 5 times their net profits in the last 5 years or in the last year. What's going on? They analyze the market using the Google Asset test. They check the balance sheets. They look at the management. They see the strategy that they want to use to expand their product. Is it good product that they can scale? All right, this is about Shark Tank. Okay, Dragon Den. Can they scale the product? Is it a good product? Can people buy that product? Is it a reasonable price they are selling it? Are they getting more market share? Who are the competitors? Are they dominating their market? Do they have a brighter future? That's the bottom line. So now they say, no, that price is too high. Are you out of your mind? Okay? And then they say, all right, fair value in a zone of $17. All right? Or between $20, $20 and $17. Here they are. 1, 2, 3, price come down here. You as an area wave trader, combining the area wave principle and Fibonacci, you start drawing your Fibonacci retracement using the common price structure that we have discussed. You highlight those key levels. If you like the story, if the company has a brighter future, you will now implement your area wave principle trading and your initial public offering, investing and trading, and you will be making excellent trading decision. All right? Have any question or suggestion Put in a comment section. And remember to put below how much you think I should charge you for this tutorial. However, it is free. But let us know how much you think we should charge you for revealing this information with you. So what I would suggest, I would recommend to traders, alright? Subscribe to 24 Stock Trader YouTube channel. You may say, George, I'm a forex trader. I'm a forex trader. I'm not going to subscribe to your 24 Stock Trader YouTube channel. And I will say to you, my friend, I'm from India, and in India we learn everything. Everything, we learn everything. Am I speaking with India asset now? Now I will say to you, all right. What we are discussing at 24 Stock Trader is more about technical trading than stock trading. All right. So we are talking about stock. We are analyzing stocks, charts, but the strategies that we are using, one can use the same strategy to trade forex, to trade commodities. So you can subscribe to 24 Stock Trader YouTube channel. That's what I'm saying. Now, when you become a subscriber to 24 Stock Trader YouTube channel, you want to watch that playlist, Mastering Common Price Structures in the Financial Market. And once you watch those videos, you want to combine those common price structure. I have posted so far 3 videos. I have 2 more videos I'm going to post in that playlist. And you want to combine them with okay, the Elliott wave trading, the Elliott wave principle, and also with okay, a thorough a due diligence or fundamental analysis. If you find this video truly useful, let us know by giving us the thumbs up. I like that, because if traders say I like, I don't like, I hate, I don't hate, I like that. Okay, I want to know what trader like, what trader dislike. So for us as a YouTube creator, you may think that, I'm not going to mark it, I'm not going to rate your video at all. Who are you? Then I will say to you, well, it's up to you. All right. So some channel you will say, notice that I like a 24 Stock Trader. I like the reaction there. I'm posting quite almost every day on that channel. And if I see that traders are not telling me that they lie, they don't lie, then I say, well, I'm not going to talk to myself, yes or no. I just go away and drink my favorite beer. Soon is okay, the beer festival in Munich, isn't it? In October 1st. All right. So I will do something else. So the point I'm making, you like it, let us know, please. All right. You dislike it, please let us know. Okay, you truly find it useful, feel free to share with your friend on Google Plus, on Twitter. So we see a lot of views. We say, all right, this is the topic, Joe. This is the topic. So they want educational Elliott with videos. That's what they want. What I've noticed for this channel, if you allow me to speak to you now, is that for 24 Elliott Way YouTube channel, what I have noticed that our subscribers are typical Elliott Way traders. Now, what I've noticed, anytime I try to deviate a little bit from Elliott Way, those traders react. They are Elliott Way traders. That's what I noticed. How do I know? By their rating, I noticed that those traders are Elliott Way traders, and they don't want me to talk about any other subject apart from Elliott Way at the 24 Elliott Way YouTube channel. So your rating is very important for us. It allows us to push the channel in one direction. So this is it for those who are Elliott Way traders trying to build a profitable portfolio by a hold. But one thing I need to say to you, very important, if you want to buy a hold, all right, you need to pay attention also to the S&P 500. So apart from everything that we have discussed today, in order to become a smart investor, you want to time the market correctly. I'm not talking time the stock that you are trading, but the market itself, which is the S&P 500. The best time to buy and hold, or the best time to start to buy and hold, is when the S&P 500 is turning from bearish to bullish, which means there was a trending phase, and then there was a correction, and after the end of the correction, it's turning from bearish to bullish. That's the best time to buy and hold. And we had that situation in 2009. The market is now in a 5th wave. This is not the best time to buy and hold. If you want to buy and hold, it's a speculative buy and hold, because you are just expecting the 5th wave to be extended. So this, hopefully, that can also help you to improve this strategy. So this will conclude this discussion about how to use Elliott wave principle to improve initial public offering, investing, or trading. Until the next time, enjoy yourself and be very happy. We are the GSTW24 traders talking about how to use Elliott wave principle to improve initial public offering, IPO, investing, or trading. Thank you for watching and speak to you soon.